Imagine you're choosing between Coke or Pepsi, Delta or United, Apple or Microsoft. Different companies, different brands, different CEOs. But what if many of their largest shareholders are the same? This isn't a conspiracy theory, it's a real phenomenon economists call horizontal shareholding. And some researchers argue it quietly changes how competition works across the economy. By the end of this video, you'll understand why some experts believe true competition in the S&P 500 isn't as straightforward as it seems, and why this matters whether you're an investor, entrepreneur, or simply someone trying to understand how money really moves. We often imagine capitalism as a fierce battle where companies fight for every customer. But modern investing has added another layer to the story. Today, we're unpacking the idea of horizontal shareholding, what it is, why it's controversial, and why understanding it can completely change how you look at the stock market. Here's what most people never notice. Imagine owning two pizza shops on the same street. Would you want them to start a price war? Probably not. You'd rather both businesses stay profitable. Now scale that idea to the stock market. Large investment managers often own stakes in multiple companies within the same industry because index funds are designed to hold broad baskets of stocks. That means the same fund may invest in several airlines, several banks, or several technology companies all at once. This is what's known as horizontal shareholding. Not one company owning another, but the same investors holding significant stakes across competing firms. Now here's where things get interesting. Some economists argue that when major shareholders benefit from the success of every competitor, there may be less incentive for companies to aggressively undercut one another. Think about it like this. If you own part of every restaurant in town, you're less concerned about which one wins. You care that the entire industry stays profitable. Now, it's important to be careful here. This doesn't mean companies secretly coordinate prices or stop competing. That would be illegal. And there isn't broad evidence that horizontal shareholding automatically causes that outcome. Instead, the concern is more subtle. Could common ownership influence incentives at the margins? Researchers continue to debate how large that effect is, and the evidence is mixed. If you've learned something new so far, hit the like button. It really helps more people discover videos like this. And let me know in the comments. Do you think common ownership strengthens markets through diversification, or weakens competition? But here's the part most investors overlook. The biggest takeaway isn't that markets are fake. It's that modern capitalism has evolved. Decades ago, investors often picked individual companies. Today, millions invest through index funds that automatically own hundreds of businesses. That shift has created enormous pools of diversified capital. For everyday investors, that's generally been a positive development: low costs, broad diversification, and simple long-term investing. But it also means ownership across industries has become far more concentrated among a relatively small number of large asset managers acting on behalf of millions of clients. The real question isn't whether competition has disappeared. It's whether our rules around competition were designed for a world where ownership looks like this. So here's the key insight. Horizontal shareholding doesn't prove that companies aren't competing. What it does show is that the structure of ownership in today's markets is very different from what most people imagine. Understanding that difference won't just make you a better investor. It'll help you ask smarter questions about how modern markets really work. If this changed how you think about investing, you'll definitely want to watch the next video, where we break down how BlackRock and Vanguard became some of the most influential investors in the world, and what that actually means for your money. Once you understand that story, you'll never look at the stock market the same way again.